Get your free copy of the complete tutorial at www.teachucomp.com/free. Besides cost behavior in general, managers should be aware of the effect of costs on profits. Cost volume profit analysis is the study of the effects of changes in costs and volume on a company's profits. CVP analysis is important for cost controlling and also for profit planning and budgeting. It can also be used when making decisions with selling prices, determining the product mix, and maximizing use of production facilities. Two important concepts when it comes to cost volume profit analysis are the break-even analysis and the contribution margin ratio. The contribution margin is the amount of revenue remaining after deducting variable costs. This amount can be applied to fixed costs, with the remainder to contribute to the net income for the company. We can use the contribution margin ratio per unit to find the amount of revenue remaining per unit after deducting variable costs. This can be helpful when deciding how to price items and when controlling costs to maximize revenue. Let's take a look at an example. Company XYZ Inc. sells softball bats for $500. They have variable costs per bat at $300. In order to find the contribution margin ratio per unit, we take the unit selling price and subtract unit variable costs. We end up with $200 for our contribution margin ratio per unit. Another important aspect to understand is the contribution margin ratio in total. This is a percentage of each dollar of sales that is available to apply to fixed costs and then ultimately contribute to net income. In our example, this means that 40 cents of each sales dollar is available to apply to fixed costs and to contribute to net income. This expression is helpful in determining the effect of changes in sales on net income. For example, if sales increase $100,000, then net income will increase $40,000, since the contribution margin ratio is 40%. So by increasing the contribution margin ratio, managers can quickly determine increases in net income from any change in sales. It's also important to understand the break-even analysis. The break-even point is the level of activity which total revenues equals total costs. This type of analysis is important so that managers can make decisions about activity levels and product pricing. At the break-even point, the company will suffer no loss, but they will also earn no income. There are two formulas used to find the break-even point. The first way is to compute the break-even point using a mathematical equation, and the second is to compute the break-even point by using the contribution margin. The mathematical equation for finding the break-even point is variable costs plus fixed costs plus net income equals sales. Because at the break-even point net income is zero, break-even occurs where total sales equal variable costs plus fixed costs. So we could input $0 for the net income into this equation. Using the data from the last example with the contribution margin ratio per unit, a company can take fixed costs, in this case $200,000, and divide them by the contribution margin per unit in order to find the break-even point in units. This shows that 1,000 units must be sold at that price point in order to break even. This is important for cost controlling as well as goal setting when it comes to sales. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.